You ever look at a company's financial report, all those numbers, and just, well, feel like you're missing the real story? How do you cut through it all and figure out what it actually means?
Yeah, what's the signal versus the noise?
Exactly. Today, we're doing just that. We're taking a deep dive into the first quarter fiscal year 2026 results for Constellation brands. This covers the period that ended back on May 31st, 2025.
Right. And our goal here really is to pull out the most important stuff from their earnings release. The CEO and CFO said, the presentation slides.
All of it.
Yeah, all of it. Help you get the key takeaways, the strategy shifts, the outlook, without getting totally lost in the weeds.
Definitely. And just as a quick reminder for everyone, Constellation Brands, they're a big player, a leading international producer of beer, wine, spirits. You know the names Modelo Especial, Corona Extra, Kim Crawford Wine, High West Whiskey.
Big brands. The mission statement is interesting, too. To build brands that people love because we believe elevating human connections is worth reaching for.
Worth reaching for.
Okay, so let's unpack this economic backdrop they mentioned. Right at the top, the results acknowledge softer consumer demand, and they attribute it to non-structural socioeconomic factors. What are they really saying there?
Well, non-structural is the key part, I think. It signals they see these pressures, inflation worries, economic uncertainty as temporary things, not like a permanent change in how people buy drinks.
So bumps in the road, not a fundamental shift.
That seems to be their take. But those bumps definitely impacted the quarter. Overall net sales were down 6%. Organic net sales, which, strips out divestitures, were down 4%.
Okay, so the core business took a hit.
Yeah, sales landed at about $2.5 billion. And then comparable operating income dropped 11%. Comparable EPS down 10% to $3.22. So you definitely see those headwinds in the numbers.
Wow. Okay, so what about the consumer side of this? They mentioned some survey work they did. What did that show? Yeah, this is pretty interesting. They have this omnibus survey, and they expanded it beyond just Hispanic consumers this time. Found over 80%, both Hispanic and non-Hispanic folks surveyed, are worried about the economy.
80%. That's high.
It is. And over 70% worried about their own personal finances.
And this is where it gets really fascinating for a beverage company. These worries are actually changing behavior, right? People are apparently socializing differently, shopping differently.
Exactly. The survey suggests people are cutting back a bit on gatherings, both out in public and at home. Less stopping at convenience stores or gas stations, too.
Which hits beverage alcohol sales directly.
It does. But here's the counterpoint.
Mm.
Despite all that, Constellation brands still managed to outperform the total beverage alcohol category by 2 percentage points in dollar sales this quarter.
So even with the pressure, they're gaining share relative to the overall market.
Right. Which points to, pretty strong underlying brand health. People might be cutting back, but they're still reaching for Constellation's brands more often than some others.
Okay, let's give it then. Let's talk about the beer business, because that seems to be where the real strength lies. The company says it continues to deliver leading share gains. What does that look like on the ground?
Absolutely. Beer really is the anchor here, even with those consumer issues. And even though net sales for beer dipped 2%, down to about $2.2 billion, it's still leading the pack.
How so?
Well, it beat the total beverage alcohol category by over 2.7 percentage points in dollar sales growth year over year. And it grabbed another 0.6 points of dollar share just within the beer category itself.
So gaining ground against other beers and against wine and spirits too.
Pretty much. It speaks to the power of brands like Modelo, that kind of affordable luxury. People might trade down, but they still want a good quality beer.
Makes sense. Any specific brands really driving that, or any surprises in the mix?
Well, no huge surprise at the top. Modelo Especial held onto its #1 spot overall in the U.S., still gaining share. That's pretty impressive consistency.
Yeah, #1. Wow.
Yeah. And Pacifico had a great quarter. Double-digit growth in volume and dollars. It was a #4 share gainer across all beer brands.
Okay, Pacifica's really stepping up. What about Corona?
Corona Extra, still a top 5 brand, definitely, but its depletions were down a bit over 7%. And remember, depletions, that's what's moving from the distributor to the retailer. It's a good proxy for actual consumer pull.
Right, real-time demand.
Exactly. Modelo Special's depletions were also down slightly, about 4%. Overall, beer business depletions dipped 2.6%. So even the strong brands felt some pressure.
Gotcha. So sales holding up relatively well, but depletions showing a bit of softness.
Right.
How did that impact profitability for beer?
Good question. The operating margin for beer did decrease, down 150 basis points, so 1.5%, landing at 39.1%.
Still a very healthy margin, though.
Oh, absolutely. Best in class. But the dip came mainly from higher costs,
Yeah.
think aluminum tariffs, things like that,
Mm.
plus more marketing spend to keep the brand strong, and slightly lower benefits from fixed cost absorption because volumes weren't quite as high. But on the plus side, they did manage to find over $40 million in savings from supply chain efficiencies, which definitely helped cushion that blow.
So they're managing cost well. What's the outlook then, looking ahead for beer for the rest of fiscal 26?
They're sticking to their guidance. They expect net sales growth for beer to be somewhere between 0% and 3%.
Yeah.
Operating income growth, 0% to 2%.
So flat to slightly up.
Basically, yes. And maintaining those really strong operating margins between 39% and 40%. And they're still investing heavily. Put over $173 million into capital expenditures just this quarter.
Where's that money going?
Mostly into brewery capacity in Mexico, building out that third brewery down in Veracruz, expanding the existing ones. The goal is to hit about 55 million hectoliters of capacity by fiscal 28.
55 million hectoliters. That's a lot of beer.
It is. It shows their confidence in the long-term growth for Mexican beer.
Okay, let's switch gears now to wine and spirits, because this is where things get pretty dramatic. Big changes happening there, focusing on higher-end brands. What's the strategy?
Yeah, this is a major pivot. Back in June, they finalized selling off a big chunk of their portfolio, mostly the mainstream lower-priced wine brands, and that included SVAK vodka.
SVT is gone. Wow.
Yep. The idea is to really zero in on the brands that have higher growth potential and, crucially, higher profit margins. It's a clear move towards premiumization.
So getting out of the volume game in mainstream wine and doubling down on premium.
Exactly. It's a bet that brand power in the higher end will deliver more value long-term than just selling lots of lower margin stuff.
That's a bold strategy. What did it do to the numbers this quarter? I imagine selling off brands like that has a big immediate impact.
Oh, absolutely. A substantial impact. Reported net sales for wine and spirits plummeted 28%, down to about $280 million. Even organic sales were down 21%.
21% organic decline. Ouch.
Yeah. Shipment volumes dropped over 30%, or about 13% organically. That reflects both selling the brands and just weaker demand in those mainstream segments they exited.
Yeah.
And the operating margin went from over 15% last year to negative 2.1% this quarter.
Negative territory. Wow. Okay, that's a serious hit. But you mentioned they're focusing on the remaining higher-end brands. Is that part of the strategy actually working yet? Are there any, green shoots there?
That's the critical question, isn't it? And yes, there are some positive signs, actually. If you look only at the brands they kept, that remaining portfolio of higher-end stuff, it delivered depletion growth of about 2% in the quarter.
Okay, so the brands they're betting on are growing.
They are. And that remaining wine portfolio actually did better than the overall high-end wine segment it competes in, both in dollar sales and volume. Kim Crawford was a leader there, volume up nearly 5%.
So the core strategy seems sound, even if the overall segment numbers look rough because of the divestiture.
Precisely. It suggests the potential is there for higher margin growth down the road, but they have to get through this transitional pain first.
And how painful is the rest of the year expected to be for wine and spirits? What's the full year outlook?
Well, they're guiding for an organic net sales decline for the full fiscal year of 17% to 20%. So still significant declines expected.
Okay, and profitability.
That's where it gets really stark. They expect the organic operating income to decline somewhere between 97% and 100%.
97 to 100%. So basically break even at best on an operating level.
Essentially, yes. An operating margin around nil or zero. Now, that factors in the divestitures, changes in how they pay distributors. They do expect some cost savings from restructuring to kick in later in the year, which should help stabilize things eventually.
Right. A major restructuring year for that division then. Let's step back a bit, connect this all to the company's overall financial health. How are they doing on cash flow, returning money to shareholders?
Pretty solid, actually. They generated $637 million in operating cash flow. That was down about 8% from last year, but still a healthy number.
Correct.
And free cash flow is actually up significantly. It's $444 million, a 41% increase. That was mostly about the timing of some of those big brewery investments, though.
Right, timing can swing that number around. What about shareholder returns?
Still a priority. They bought back shares over $300 million worth, $381 million if you count through June, and they declared their regular quarterly dividend $1.02 per share.
So, despite the headwinds and the big wine divestiture, they're still generating cash and sending it back to shareholders. What does that say about their overall financial strategy and stability?
I think it shows continued discipline. They kept their net leverage ratio, that's, debt relative to earnings, right around their target of 3.0x. Dividend payout also steady around 30%.
Maintaining their targets?
Exactly. And their full-year targets for cash flow remain unchanged. They're aiming for $2.7 to $2.8 billion in operating cash flow and $1.5 to $1.6 billion in free cash flow for fiscal 26. So it paints a picture of, stability and predictability, even with all these moving parts.
That's reassuring. Seems like a carefully managed situation. Any other key updates from the quarter we should mention?
Couple of things. They're continuing to invest, like we said, about $1.2 billion in total capital spending planned for the year, with the lion's share, about $1 billion, going to the Mexico beer operations.
Still betting big on beer.
Clearly. They also put out their 2025 ESG report, Environment, Social Governance, highlighting things like sustainability, community work, responsible drinking initiatives. Ties back to that worth reaching for mission.
Okay.
And one last thing, a change in leadership for investor relations. Blair Venema is taking over from Joseph Suarez. That was effective July 3rd.
Good to know. Okay, so let's wrap this up. We've gone pretty deep into Constellation Brands' Q1 FY26 results. We've seen a company facing, real consumer pressure,
Definitely.
but navigating it by leaning hard on that super strong beer business
Yeah.
while making some bold strategic moves to reshape wine and spirits for more premium growth down the line.
Yeah, the story really feels like one of resilience, strategic focus, even when the broader economy is challenging. They're clearly adapting the portfolio, managing their capital, trying to build long-term value, even if it means, like we saw in wine and spirits, taking a short-term revenue hit.
So what really stands out to you from all this? For me, it's maybe that contrast, the steady strength in beer versus the radical surgery in wine spirits, or just how much consumer mood seems to be dictating these shifts.
Yeah, I think that's right. And it raises a really interesting question for you, the listener, to think about. How might other companies, maybe in different consumer sectors, use this kind of dual approach? Reinforcing their winners while making really tough calls to reposition weaker parts of the business, especially when facing similar kinds of economic headwinds affecting how people spend their money.
Hmm. A fascinating strategic puzzle indeed. Something to definitely chew on as you watch other companies navigate these times.